I want to bring in our guest, Savita Subramaniam, of course, Bank of America Merrill Lynch's chief US equity strategist, with her updated S&P 500 call at 2450, and Mark Okada, so bullish it hurts apparently. That was a couple of months ago. Highland Capital co-founder and CIO. I'll get to him with that in just a moment. Savita, I want to begin with you. An upgraded target for the S&P 500. It's a simple why.
Why? Well, I mean, so basically we think our bear case is less likely, and our bear case was an economic recession. That's looking less and less likely given the indicators that we're looking at. The other reason for the upgrade is that we think we're moving into that final stage of a bull market that's marked by euphoria. Investors go all into stocks, and you have, right now there is actually a tremendous amount of money sitting in bonds and cash that has a potential to move into stocks if interest rates continue to rise. So it's really a question of sentiment driving the market more than just fundamentals at this point.
Well, Savita, if that's where we're at, we're almost gripped by euphoria. Is this really a market you want to chase?
Well, I mean, if you look at our upside built in, it's 3 percentage points away. And I think the rest of the year is going to be choppy. I think we're probably due for a pullback. I mean, the surprising thing is that 10% pullbacks happen on average about once a year. So we might be due for a pullback, since we haven't had one since last January. But that said, I think that if you were to think about buying or selling today with the year end as your target, we think there's more upside than downside risk to the market at these levels.
Mark, from where you sit, do you agree that part of the rotation out of bonds into stocks is going to lead stocks higher?
Absolutely. I mean, we're sitting on average cash balances are still over 5 or close to 5%, which is high by historical standards. So that rotation is coming down a little bit. People are going into the stock market, but it has a bit to go. So I think just from a technical standpoint, it would be hard to fade this market. And I disagree a little bit on the fundamentals. I think the fundamentals have gotten better. We've seen revenue sort of for the S&P companies rising along with earnings, which was very different than we've had last year, where we had an earnings recession. And now we're talking about a nice rebound in earnings across the board, which really kind of happened well before the presidential election. And that strength is continuing into this. But I think the call around bumpy is certainly a good one. But I'm not sure I would fade this rally a bit.
So, Savita, what's your pushback on that? When you wind up having the better earnings season, of course, the dollar strength isn't as much as a deterrent as it was in the last few years. Oil prices have wound up stabilizing. You have loose financial conditions, and you have the soft data really coming in quite strong. How do you square that with what you think the fair value of the S&P is?
Well, here's the thing. So the fair value of the S&P is a bit lower than what our target is, and that's really predicated on a normalized valuation measure. And as you and I know, valuations are a terrible predictor of near-term market returns. If you'd sold the market in 1998 because it was too expensive, which it was at that point, you would have lost a lot of money over the next couple of years. So I think that really our fair value model is looking at a normalized valuation framework and saying, okay, valuations at these levels are high, not a reason to sell, but kind of on a normalized basis, the fair value of the market is a 100 points or so lower than our forecast.
Mark,
but and I agree on the fundamentals. Yeah. I think that fundamentals are improving. I just think that when I talk to investors, the pushback I get on the market is largely driven by valuations. The market's too expensive, and our point is that the market can look a heck of a lot more expensive before it hits the top, and that's what we've seen in prior cycles. I
want to bring in Mark Okada. Mark, you came on the program about a month after the election win, and I remember you said, I'm so bullish, I feel uncomfortable. Do you still feel uncomfortable?
Oh, I'm a credit guy, so of course I'm very uncomfortable. We're always uncomfortable. We worry about everything. But I think what's been very interesting to see as this rally has continued, the numbers keep getting better. I think the setup is interesting, though. There's a lot of people that are pushing back on the rally because they think this is a Trump rally. And as I said last time I was here, I don't really see that. I see this as a sweep rally, and that sweep is getting to be much more than just the two houses and the presidency. We've got probably the Fed in the mix now with 3 appointments there, along with the Supreme Court. Now, that setup is a great setup for getting something done. Policy is going to take a long time, as we saw this morning with the health care bill and all the debate going back and forth on that. But regulation is something that certainly can change very quickly. We have $1.9 trillion estimated in regulatory costs for the U.S. economy. That's 10% of our economy. That's a crazy number. And someone in the finance area will understand this very easily because we've been running into it constantly for the last 8 years. And as that starts to move back, there's certainly a lot of productivity, a lot of capital that gets released, and that's very good for markets and the economy.
So we got Savita, sort of the constructive, reluctant bull, and then Mark, still pretty bullish. We're going to get more into that call on credit as well. Savita Subramanian of Bank of America sticking with us, as well as Mark Okada of Highland Capital. And coming up tomorrow, Bloomberg's Francine Lacqua interviewing JP Morgan CEO Jamie Dimon, 7:30 a.m. Don't miss it. This is Bloomberg. This is Bloomberg Daybreak. I'm Alex Steele. Well, if you want to go in the market where risk is really being taken on, it's in the credit market. Take a look at the Bloomberg here. This is the investment grade versus high yield spread to treasuries, right? So the blue line is investment grade. The white line is high yield. That's at post-crisis tights. And the investment grade spread, 121 basis points. That is a risk-on search for yield if I've ever seen one. Savita Subramanian, Bank of America, Merrill Lynch, and Mark Okada, Highland Capital, still with us. Does this chart make you want to sell?
Well, I think that you're looking at fixed rate debt there when we look at that, and absolutely, I think fixed rate has run a bit too much. We've got we've gone from 0 to 100% on March. I think we get at least 3 hikes this year. I would be fading rate risk, and IG has a lot of it, and high yield now does, because a big portion of the high yield market is trading with a four handle.
Yes.
That's not high. That's some yield, so it's better than treasuries, but it's not a high.
Some yield index.
Yeah, some yield.
So you see yields wind up moving higher?
Yeah,
and
I
then
do.
you have
I do. If you look at Barclays Ag, right, and it's down almost 2% since the election. Floating rates up almost 3%, so that's been a good sort of rotation. You actually have high yield bonds trading about the same nominal yield as loans. So you can rate. So there are places in credit to rotate, but to your point, right, spreads are tight across the boards. We've had a lot of money flowing into space. You got to get defensive a bit around what you own, and so the call is really about, as opposed to selling, let's get active. Let's figure out which names we want to own. A lot of this index money really is going to have trouble in here as the beta gets a little stretched.
Well, let's get a little bit more specific. You brought up the Bloomberg Barclays Ag, so let's talk about it. I looked at the breakdown of it, and if you look at it by maturity, the outperformance has come from the longer maturity stuff.
Yeah.
Why?
Well, it's because there's not a ton of bonds in some of the longer maturity. So this technical sort of dynamic takes over a bit there, and it kind of helps with that. I see most people are very bullish on the very long end of the curve because it's still fairly steep. And then when you come in and you see what the Fed is doing, pushing up shorter rates, that's going to make the nearer maturities, which is also a pretty crowded trade, get technically.
Interesting you mentioned scarcity, because issuance has swelled so far this week, and we've seen 10-year, 30-year tranches from many of those issuers.
It's starting to come.
Is it starting to come in a big way because the window's starting to close?
I'd do that.
And same for corporates, because we've seen that in corporates too.
Yeah, wouldn't you be borrowing as much as you could, as the Fed has signaled they're going to normalize rates, and I would be, and certainly fading the 10-year and 20-year and 30-year if you were a corporate. I mean, lock in those low rates. That makes a ton of sense, and the market's open. Market is wide open.
So, Savita, we were talking about sort of the risk in the credit market and looking at those tights and high yield and investment grade as well. Is it the same kind of risk in the equity market? Are we seeing the search for yield continue there, and is that exposing equity investors to some kind of risk when the Fed hikes?
Yeah, I think that's been the story for the last 8 years now. But if you look at leadership, I mean, it's true. We've had, a paucity of yields. We've had utilities and staples selling at, the highest multiples we've ever seen. So, yeah, I mean, certainly there are vestiges of that could continue since the rates are still super low. But I think it's interesting to see leadership from maybe, February of last year to now it's been a remarkable rotation out of yield plays and bond proxies in the market and into some of the more cyclical areas. Banks have done really well. Financials have generally led, although, they had a bit of a pullback recently. So I think that what we're doing is we're sort of slowly exiting this lower forever interest rate environment that we were kind of mired in and moving into an environment where a little bit of a rise in interest rates is fine as long as growth is keeping up with rates. And that gives you the latitude to move into some of these beaten down sectors that haven't really done anything for a very long time, like financials. That's one of our favorite sectors. And I think it's basically been hurt by disinflationary pressure and low interest rates, and it could actually start to come to life again. Now, one thing I would point out on the leverage side is that, interestingly, as you pointed out, and we've recently seen this surge in debt issuance. Now, what worries me is not only do you have the Fed potentially on a rising interest rate pattern, but you also have the potential for the removal of the interest expense deduction for U.S. corporations. So what this does is, overnight, it increases the cost of leverage by 25% if companies lose the ability to deduct their interest expenses. So what I worry about within the market, where I think the bigger risks reside, are in some of these super levered companies like the materials sector, some industrials. You look at utilities, staples. Like, there are some really levered pockets of the market that are trading at still fairly high multiples and not really adequately reflecting this risk.
They're talking about a phase-in of something like 3 or 4 years for that, and also they're talking about grandfathering the existing debt. So I don't think it happens overnight, but it is an issue to look for. And when we look at tax reform and what's going on, I think that's an 18 sort of issue. So it's something to keep your eye on.
Sure, but
I don't think this is an overnight sort of issue.
I think, though, that what could happen is that all these companies that are racing to issue debt today, what if it's not grandfathered in? What if it's phased in over time, but you're sitting at fairly high leverage ratios for the S&P 500? So that is one risk where I don't think it's a near-term risk, and as we're positive on the market. But longer term, the fact that leverage ratios are now higher than they were in 2007, makes me a little bit nervous about the longevity of this bull market.
As you should be.
You guys are just getting going, and the producer's screaming in my ear to wrap things up. Highland Capital's Mark Okada and Savita Subramanian, thank you very much. We're going to try and get you both to stick with us. Coming up tomorrow, we have full coverage of the European Central Bank's rate decision, followed by President Mario Draghi's news conference. That is coming up in full tomorrow, plus a conversation you don't want to miss with this man right here, the JP Morgan Chase Chief Executive Officer, Jamie Dimon, sitting down with Bloomberg's Francine Lacroix at 7:30 a.m. Eastern Time, 12:30 if you're in London, 8:30 p.m. if you are in Hong Kong. From New York City, counting you down to the opening bell, you are watching Bloomberg.